So when it comes to retirement, you need two strategies in order to retire. So the first strategy you need in your 40s, 50s, and early 60s, where you grow your portfolio long term, reducing taxes as much as possible. Why do I know that? Because, well, I'm a CPA. And the second strategy you need as you get closer to retirement should be a monthly passive income strategy that generates a more predictable cash flow so then you can use that cash flow to pay for expenses like rent or utilities or food costs or whatnot. So then if you are investing, you actually need to learn these two strategies. So in the free training, I share the two strategies I use in order to accelerate my retirement. So right now I'm 31 years old and I actually achieved my first retirement goal, which is the lean FIRE goal. And you can see how I have been investing for the last 6 years and how I achieved that goal. And I share some of the great lessons I learned along the way and some of the painful lessons I learned along the way with you as well. It is a very intensive and comprehensive training, so make sure you watch till the end. It is actually around 3 to 4 hours long, so make sure you take out your notebook, and this training will definitely be worth your time.
So hello everybody, and welcome to today's webinar on how to get 30% from the stock market in 12 months. So I see people are just signing in right now, so we can just wait a little bit and let's get started. 30% is pretty crazy. Is that even possible? So I'm sure this is a question that you have in your mind right now, so let's address the elephant in the room. If you arrive on this webinar, there are mainly three types of people in the stock market. The first one, people who are getting negative return because you don't have an investing strategy or you have an incomplete strategy. So either of these would lead to a negative return. People who are getting around 5 to 10% return, and this is when you have a balanced portfolio or when you invest in ETF funds, so that's what you would typically get. And there's actually a third group of people that can get 30% return a year. So I'm really talking about people who are getting somewhere between 20 to 40% return. In this webinar, we're going to dive into strategies that can achieve this kind of return, and I'll also go through many examples on how to analyze a stock to get there, so make sure you stay till the end. So my name is Seto. I've been investing for over 10 years, almost 13 years now, and so far for the last 6 years, I've been using one strategy, and my return is 440% for the last 6 years. I started investing when I was 18, and I tested over 300 different strategies for 8 years. And now I'm growing my portfolio using the strategy I'm showing you today. My portfolio is around 700, 800K. My plan is to continue to grow that at 30% per year. 440% is such a big number. If you annualize that, the average return is 31% per year. And my strategy is called long-term stock options and monthly passive income. If you come by my YouTube channel or my Quora channel, I go by the name Seto, and I'm a chartered professional accountant in Canada. My mission is to help people without a financial background to master investing and target 30% return from the market. If you go to my YouTube channel, you will see that I have 200-300 videos uploaded teaching people about economics, news, how to analyze stocks, how to manage your risk. Let's talk about who this webinar is for. It is for full-time professionals who are planning for retirement. If you're a full-time professional like doctors, nurses, accountants, engineers, government workers, this webinar is made for you. You want to get results ASAP and you need to master investing. If you have been investing for a while or you just started, but you're getting less than 30% return, so there's that room for improvement, people who have at least 5-figure to a 6-figure portfolio, at least 10,000 or higher. To today's agenda, how can you invest in blue chip companies and still make 30% return like private hedge funds? The 3 most common mistakes made by average investors and how to fix them. The 5 investing strategies that don't work and why, and a 3-step formula to invest like a hedge fund and transform your financial destiny. In terms of house rules, this is not a get-rich-quick webinar. This is not a do nothing but click a button and make money. And this is not a day trading or investing in penny stocks to get rich. We focus on proper research, we focus on low-risk opportunities, and we lower our risk as much as possible when it comes to investing. There's an earnings disclaimer because the results and my clients' results are not typical. So no one can guarantee you a return in the stock market. If you are looking for a guaranteed return, then, well, you wouldn't find it in this webinar. But what kind of investor do you want to be? There are really 2 choices, short-term or long-term. If you want to be a short-term investor, then you should be prepared to commit 40 hours per week. You need to trade continuously and frequently. If you have a full-time job, it is really difficult to sleep at night knowing that you're a short-term trader. I have done that for around 6 to 8 years in my life. I gotta say, it influenced my relationship and my health a lot. So I don't want to be a short-term trader. So instead, I'm a long-term investor. I commit 1 hour a week or less. When I was working in Big Four accounting firm, I was working 60 to 80 hours a week. So then long-term works much better. I focus on buying great companies at a discounted price, and you get rich slowly, but you sleep better at night. Here's really the first mistake that most beginners make, is that 95% of day traders fail. You want to avoid being a short-term trader and focus on long-term because you want to let the market work for you, not the other way around. Here's my trial and error history for day trading, short-term trading, small cap stocks. I initially started in 2008. I tried day trading and I failed. It was just way too time consuming. I tried Forex in 2009, didn't work out. I tried technical analysis, but it was incomplete, and I'll talk more about that later. I even learned programming so that I can start automating some trading strategies using technical analysis, combining with different indicators I find online. I Googled a bunch of different strategies. This is the part where I tested over 300 strategies, and turns out a lot of them didn't work. Some of them worked, but not in every single situation. In 2013, I tried value investing, but it was too time consuming. This is really the Warren Buffett approach. In 2016, I listened to my friend's advice and invested in a mining type company, and it failed. It actually went bankrupt. I invested in a junior gold mining company, and that didn't work out as well. I invested in airlines right before COVID, and I also invested in Alibaba during China regulation. So I definitely have my fair share of trial and error. Let's talk about why can't the average investor do this on their own. Short-term investing is really too time-consuming for the average investor with a full-time job. The average investor, like you, with a full-time job is not going to learn programming just to test out hundreds of strategies. It's just not efficient. Here's some food for thought: long-term versus short-term. Do you know which time frame is the easiest for beginners? Do you know which time frame is the most reliable? Do you know how to find safe and stable companies that grow year after year? Do you know how to take advantage of these companies when they're on a deep discount? Are you a fundamental or a technical investor? This is the second most important decision you need to make. A lot of people don't think about that. They are either fundamental or technical. So what are the differences? Technical analysis focus on studying the price and the pattern. They draw support and resistance lines, and they believe that all information is reflected in price. For example, COVID, that's reflected in the price. Russia-Ukraine war, that's reflected in the price. Companies expanding into China, reflected in the price. All they do is they look at the price and they trade the price, and that's it. The other side is a more accounting-driven approach, fundamental analysis, studying financial statements, looking at PE ratio. This approach is very similar to Warren Buffett, where you believe the company's financials drive the stock performance. Here's the mistake that most people make: choosing one specific camp of investing analysis, ignoring the other one. The truth is, you need both technical and fundamental analysis. Each of them is for a specific purpose. You need to combine both to get the best results. During the period where I was testing over 300 different strategies for technical analysis, the maximum success rates you can get is really around 60% to 70%. Once you hit that ceiling or plateau, then you need to use other analysis like fundamental to get you to a higher probability investment. Let's talk about why can't the average investor do this on their own. The average investors usually learn technical or fundamental analysis, but not both. Mastering fundamental analysis requires a strong accounting background. It can be quite confusing. For example, myself as a CPA, and it takes 3 years of work experience plus 6 exams in order to get that designation. People who master technical or fundamental analysis do not know how to put both analysis together. Technical versus fundamental. Do you know what are the two most important indicators in technical analysis? Do you know the major pitfall of technical analysis specific to the indicator you're using? There's no such thing as a perfect indicator. Do you know how to manage and limit your risk when investing in a market? And do you have a systematic exit to capture profit in the market? Do you know how to extract information you need from 300 pages of financial statements in 30 minutes or less? This is really a shortcut I learned as a CPA. Do you know how management manipulate the financial statements? And do you know how to avoid a stock when the CEO and CFO are dumping the stock? In the very beginning, I said there are 3 groups of people. People who are making a negative return, people who are making 7% per year, and some people making 30% per year. So who are these people that are making 30% per year? The answer is hedge funds, private equity funds, and investors who know how to use leverage. Here is really the mistake number 3, not knowing how to use leverage to maximize your return. Here's an example of a hedge fund manager, Bill Ackman, making 58.1% return in 2019. He knows how to use leverage. He knows how to use options. What makes hedge funds and private equity funds different? Here is really the hedge fund formula. And after working with them for 3 years, this is basically how they invest. They focus on buying a few great companies at a discounted price, and they use leverage to double or triple their return. Now, in our case, we're going to be using stock options. For private equity funds and hedge funds, they're going to be using a bank loan. So it's slightly different, but this is what they focus on. They do a lot of research to make sure that they're really confident in the first parts, then they can leverage and double their return. Let's talk about why can't the average investor do this on their own. First, average investors cannot really access private equity funds. The minimum investment is usually $100,000 US or more. For some funds, the minimum investment is actually $300,000 or more. The average investors do not understand stock options because it is quite complicated, and they take on too much risk without increasing the return. Average investors do not know how to research and find companies that they're 95% sure they'll win. The average investors are scared of the market crash and losses because they don't have a consistent compass to navigate the market. How can you apply the private equity formula? Do you know how to find blue chip companies at a discount using an hour a week? Do you understand how to invest and multiply your profit using stock options? Do you know how to find the best strike price, expiry date that controls your risk while maximizing your return? Do you know how to minimize your diversification and maximize your return in your portfolio when there's leverage? All these things need to be executed with a lot of care, and you need to be very careful when you're using leverage. The next question you might have is, well, can this formula be applied to the stock market? That's what I have been doing for the last 6 years. So far, my return is 440%. In the last 6 years, I've been using this strategy. I'm showing you my retirement accounts in Canada, which is TFSA, and RRSP on the right-hand side. So it's around 240,000 to date. My regular investing account, which I started later, which is around 327,000 US dollars. Together, it's almost $700,000. The total return is 440%, which works out to be 31% annualized per year. If you look at the same period, then the annualized return for S&P 500 is 17%. I'm approximately 2 times S&P 500 in terms of annualized return. My previous full-time job is working in KPMG as an auditor and a financial advisor for private equity funds and hedge funds. I have a chartered professional accountant, CPA designation in Canada, and I have a bachelor and a master's degree in accounting. I also worked on a couple of startups during my university days, and I'm also a speaker of data analytics. Back in university, I was teaching accounting, and I was also teaching data analytics in KPMG as well. I worked in KPMG for 8 years, and for the last 3 years or so, I went to Hong Kong KPMG to help different private equity funds and hedge funds to buy companies around the world. By age 30, I have achieved my lean fire goal. At this point, I wanted to transition to coaching and basically teaching people how to invest in the market, especially for people without a financial background and having a full-time job, or you're almost retirement and you want to have a boost in terms of income and target 30% return. My investing strategy is called long-term stock options and monthly passive income. You need the first part if you are earlier in your life, like your 40s or 50s, when you're looking to grow your portfolio and your retirement accounts. So in US, it will be IRA, Roth IRA. In Canada, it would be TFSA and RRSP accounts. That's where you would use long-term stock options. Once you get closer to retirement or early retirement, then at that point, you want to be switching over to monthly passive income, where you can still get 30% return, but it will be more predictable. So then you're getting like a monthly passive income to replace your salary. If you're closer to around 60 or even 70 and you want that boost in terms of monthly passive income, then I also cover that as well. Does this work for other people? Let me introduce you to Mary. She's one of the students in the program, and she's an accountant in Sydney. She used to just put her money into savings account to earn 0% or 1% interest rate. After she learned the strategy, she invested in one of her favorite clothing brand, Aritzia, so the girls in Canada will know how pricey Aritzia is, and she made 42% in 18 months. The next person is Stacy. She's another student in the program. She's a consultant in San Francisco, and she used to invest in UK bonds for 1 to 2% return per year. After she learned a strategy, she invested in Starbucks because she goes there a lot, made 33% in 4 months, and Disney 40% in 11 months. You can see her testimonial here at this link. The next girl, Carolyn, she is another student in the program. She's a controller in Vancouver, and she previously was making less than 2% return from day trading, basically getting inconsistent results. After learning the program, she applied it to Facebook, made 79% in 7 months, and 90% from Intel in 5 months. Now she's closer to retirement, and she's looking to use this investing strategy to plan for her retirement as well. You can see her testimonial here. What if you have zero financial background? Because Stacy, Carolyn, and Mary, they all have a financial background. Here are some people with no financial background and still master investing. John, he's a government worker in the United States, and he previously followed TV analyst advice and lost money and entering at a high. After he learned the strategy, he made 57% from Dollar Tree in 5 months using stock options. He's a real estate investor on the side as well, so he's using stocks as a method to diversify his overall portfolio. Benson, engineer in Vancouver, Canada, and he previously invested in mutual funds that gave him 5% return. After he learned the strategy, he made 90% from Shake Shack in 4 months using stock options. He made 100% from AMD without using stock options. Ben is the second student who made over 100% from a single investment as well. You can watch his testimonial here. Lee, she's a data analytics person in Texas, and a long time ago, she lost $40,000 back in 1990s, and she lost her confidence to invest. After she learned a strategy, she's able to do research and regain her confidence. She made 65% from Activision and Blizzard in 5 months, and made 125% from Nvidia in 5 months as well, using stock options. Lee is the 4th student making over 100% from a single investment in my program. You can watch her testimonial here as well. Let's talk about the summary stats. In total, I have over 300 students in the program, and to date, every time a student shares their success with me, I'll record it. There are 677 successful exits in the program. Within 300 students, 138 students made 30% from their first investment. So first investment is usually the hardest. That's why I keep track of this KPI. I only record the students that exited their investment. If they're still holding on, I don't count them. If they're still going through the program, then obviously they don't have an investment yet. Within the community, 37 students made over 100% from a single investment. Within the community, there are 2 hedge fund managers as well. So these are the students that went through the program and then they decide that they want to open their own hedge fund. One student, as of the time I'm doing this webinar right now, is working with me to start his own hedge fund. I guess in total, there will be 3 hedge fund managers coming out of this program. Let's talk about how has investing changed my life. I gotta say, when I first started, I came from a lower family. I started investing by saving after work, and I started with only $10,000. I saved a lot of money over the years. I tried to cut any unnecessary expense, and I achieved lean FIRE at 30. So for those of you who don't know, FIRE stands for financial independence and retire early, and lean FIRE is kind of like the first stage you achieve, which is kind of the minimum to comfortable level of retirement, and then you would achieve your regular retirement and then your wealthy retirement. So those are the 3 stages. I got there at 30, which is great. If you are able to get 30% per year, then this chart in the middle is what your projection would look like. Here you can see if you start with 100,000, then the second year will be 130,000. The next year will be 169,000, 219,000, and 285,000. We can see here the incremental gain is around 85,000 in the 4th to the 5th year. On the right hand side, I have a screenshot of my retirement account in Canada, which is my TFSA account mainly with RRSP. You can see that over time, my portfolio increased value by 187,000. That's where I'm at right now with my retirement accounts. My goal for the next 5 years is really to continue to grow my portfolio, which is approximately 700K, to reach 2 million by 2027. This is my next big milestone. I think I'll be able to get there in 5 years or so. I'm using a number 600K to start. This year, my goal is to make 180K, which will take me to around 780,000. And then going forward, 1 million, 1.3, and 1.7. So I think at year 10 or year 11, I'll be at around 2 million, which is 2027. What does that mean to you? I shared my goals with you, and I just want to help you set some goals so you can gain more clarity before we dive into the specific techniques of investing. Typically, the people I work with have the following goals. They want retirement, whether that is generational wealth that they can pass on to their kids, or they want cash flow for a more comfortable retirement, financial freedom. If you're working a full-time job, then you might want less reliance on your full-time job as your only source of income, which means less stress, which is great. Traveling, so free of local constraints, and you have the ability to make money anywhere. This is especially true if you have rental properties and you want to diversify your portfolio. There are quite a few real estate investors that come to me and say they want to learn how to invest in the stock market because real estate is very location based and you want to have a method of making money even though when you're traveling in Europe, for example. Right now, I'm also saving for my kid's education. This is also one of my goals, planning for his university and perhaps master's degree as well. If you're planning to retire in the next 5 to 10 years, then you want to start using the long-term investing strategy first. As you get closer to retirement, like 60, 65, you can switch over to monthly passive income for a more predictable cash flow. Now, the reason why you want to do this is because for monthly passive income, it gets taxed like salary. It's like you're getting a salary from the stock market. If you are retired already and you want an extra boost of income for a better retirement, then you would want to implement the monthly passive income strategy first. Once you gain a certain level of cash flow and you're comfortable with that, then you can allocate some to long-term investing again. For both, it's really a matter of how much you want to allocate in long-term versus monthly passive income. When you hop on a call with me or my team, we'll also help you figure this out. Let me just show you some numbers and how you can possibly retire in the next 5 to 10 years. Let's say you're starting with $100,000 and you're saving $1,000 a month. If you're making 30% return a year, then this is your portfolio balance on how it would be growing over time. For example, year one, your year-over-year gain is $30,000. You save $12,000. So then at the end of year one, it will be $142,000. And in the year two, you'll be close to $200,000, $260,000 in year three, and $350,000 in year 4, and $479,000 in year 5. Now, what you observe here in this red box is that if you make 30% from year 3 to year 5 onwards, at year 5, you'll be making $107,000. This can be long-term investing or this can be monthly passive income. From a lot of the discussion I have, if you hop on a call with me, we'll help you figure this out as well. Most people can achieve retirement here. Now, 100,000, which is approximately 8,000 per month. And if you have some other income streams as well, then you will get there even faster. But I think most people will achieve retirement at this level. This is the portfolio balance you're aiming for. If you hop on a call with me or my team, then we'll dive into a more personalized situation for you. If you want to have an even more ambitious or luxurious retirement, then you can keep going. And at year 10, you'll reach approximately 2 million. At that point, the year-over-year gain is 400,000 per year. For people who are living in New York or more expensive cities, you might want to aim for a higher income. As of right now, I'm in already this year 4, year 5 stage using my strategy. My goal in the next 5 years is really to reach approximately 2 million. That is my FAT FIRE goal, which is FAT, financial independence and retire early goal. That's my path going forward. Now, if you're wondering what is the monthly passive income you'll get, then I'll also calculate it for you here because when you invest, for the first couple of years, you might focus on long-term investing. Once you get closer to your goal, like year 5 or year 10, then you would switch over to monthly passive income. If you are using just $100,000 and you get 30%, that is already $2,500 per month of monthly passive income. If you're looking for a short-term boost in terms of monthly passive income, this will already be a great help to your family and your cash flow on a regular basis. If you are at this 300K level and you make 30% per year, which is around 60K, then your monthly income increase will be 5.5K. This is assuming you implement the monthly passive income with 300K. This is going to be replacing maybe half of your salary, if not more. And if you are looking to completely replace your income and then some, and if you're investing in $1 million, here you can see investing 1 million or 1.3 million will get you a year-over-year gain of approximately 300K or so, which is around 26K per month. So I think this should give a lot of people a very comfortable retirement. Like I said, if you hop on a call later on with my team or myself, then we'll set up a tailored goal for you as well. Now, even though this strategy works quite well, you're not going to put 100% of your portfolio with this strategy. I usually recommend people to spend 20 to 50% of your portfolio with this strategy. The rest might be in mutual funds or real estate. Then you have an overall diversified portfolio. Now, for myself, because this is what I'm starting with, 100% of my capital is actually using this strategy. But I think as you are learning the strategy, you should start with a smaller amount. Let's talk about what is the minimum investment you need to use my strategy. Now, the absolute minimum is $10,000 because the nature of using stock options, like one investment is like $5,000. So the absolute minimum capital you need is $10,000. You can't go lower than that. Usually, I recommend people to start with $20,000. Then when you're getting 30% return, the first year will be $6,000, and that would already give you a monthly income of $500. So if you have $20,000 to $30,000, then you can already start using my strategy, whether that is long-term stock options or monthly passive income. Usually, if you have more capital, then I would suggest you to start with 50K to 100K. That will give you more diversification. Once you gain the confidence and the skill, then you can scale up. Let's say you have 500K to invest. Obviously, you're not going to use 500K with this strategy immediately. You might just start with 50K, something you're comfortable with, something that you think, hey, if you get 30% from that, that is 15K for the first year, which is fantastic. Once you gain that skill, then you will be in a much better position to gauge and assess exactly how much capital you want to allocate to this strategy. Then you can scale up accordingly. That is really how I think most people should progress. If you do it right, I think after 6 months, you can reassess and then scale more. And after another 6 months, you can reassess and scale more. My role here is really to help you speed through the learning curve, learn the strategy in the first month, then you can get it rolling in the second month. At the end of the day, I think we can all agree that nobody wants to lose money in the markets. Nobody wants to feel like they're gambling in the markets, which is why you need to do research. Nobody wants to get less than 7% in the market, and nobody wants to risk their life savings on penny stocks or day trading. What do you need to succeed? After working with 300 people, here are the 3 key pillars to success. You need guidance from someone who has done it before, and this can be in the form of video coaching program, where it takes you from picking the right stocks, researching, entering, multiplying your profits to exits. This is the complete process. You need guidance over investments you want to buy. You need help with getting in and out of the market, especially for the first couple of investments after you learn, because that's when you might make mistakes in terms of implementing the strategy. You want someone there to make sure that you're not taking on too much risk. You need to know people who have the same strategy as you, and you need to understand what they're buying. You'll save a lot of time of researching by looking at what other people who have the similar strategy as you are investing in as well. Let me introduce you to Investing Accelerator. This is my coaching program where I help full-time professionals without a financial background to master investing. There are 3 key success factors of Investing Accelerator. First is the video coaching program, and you'll learn one strategy, which is long-term stock options and monthly passive income. Even though there are 2 parts to this strategy, the underlying fundamental philosophy and the research process is exactly the same. Then the second part is weekly coaching call. That's where we cover the latest stock ideas, the overall market analysis, and whenever I buy or sell, I'll also email you as well. If you want to follow me, you can follow me. Of course, you will completely understand the investing strategy, which is what's important. The third part is the private Facebook community where you can ask questions and see what other students are investing in. This is a great community. We're quite active as well. The first part is the 4-week coaching program. You can watch it anytime, anywhere. It is a step-by-step, click-by-click video. My strategy is called long-term stock options and monthly passive income. In terms of the approach, you'll learn the best in terms of technical, fundamental, risk management, portfolio management, insider, stock options, and exit. If you're wondering if you have an incomplete strategy or not, you need to have all the components. If you don't have all the components here, then it means you have an incomplete strategy. When you join the program, you do not need to have any financial background in order to use this strategy. Because I'm the CPA, I'll teach you that. You don't need to have any prerequisite to join this community. Now, in terms of the time commitment to learn, it's 4 hours a week for 4 weeks. Most people with a full-time job can execute it. In fact, most of my students in the program are busy full-time professionals. If they can do it, I'm sure you can do it as well. After 1 month, you will be ready to find your first investment. This is usually the time it takes for people to finish the foundational knowledge, then they will be ready to invest. If you are retired, then you can go through the program a little bit faster, like 3 weeks or so. If you're busy, you need an extra week or two, that is fine. What's important is that as you go through the 4-week coaching program, you ask me any questions you have. I'm here to support you along the way because you'll have a lot of questions, so that's why I'm here to help you. Once you learn a strategy, then the time commitment is approximately 1 to 2 hours a week because we mainly focus on long-term investing. Here is the screenshot of the membership site. Here you will see Investing Accelerator. This is the main program, and within it, it has everything you need to know to target 30% return and monthly passive income as well. This is what you should go through first. For a weekly group coaching call, this is where we analyze stock ideas and we go through new stocks every single week. This will save you a lot of time when it comes to researching. Let me share a successful case study for you. Val, she's an analytics manager in Vancouver, Canada. In the past few years, she was focused more on career development and only came to think about wealth management recently. When she did have the chance to explore some of the potential strategies, there were so many and she felt overwhelmed. And she was investing in mutual funds and only able to achieve 8% return a year. After learning the strategy, she actually found this stock herself. It is a Canadian auto parts company. I do not know what this company is, but she's able to make 35% from it using stock options. That is an example of a student who went through the program in 1 month, accelerated her learning curve, and then she's able to become independent and start making investment decisions herself. The second part of the program is weekly group coaching call. Every weekend, I'll go through any questions, stock picks submitted by you and other students. I'll also go through any stocks I'm about to invest in as well. This will save you a lot of time when it comes to researching. Here I attach a couple of screenshots of the weekly group coaching call. You can see 3M, Take-Two, these are big blue chip companies. And we also analyze Intel. We also analyze some of the major macroeconomic events like increase in interest rate or COVID or the war between Russia and Ukraine and how to best play that scenario. If you have an idea after you finish the 4-week coaching program, then of course I'll analyze it for you during the weekly group coaching call. I'll double check your work to make sure you're on the right path. If you don't have any ideas, then you can just watch the latest weekly group coaching call for my ideas and other students' ideas as well. I'll email you whenever I'm buying or selling in the market. If you want to follow me, you can follow me as well. When I'm analyzing the stock ideas, I rank it from the most ready to the least ready every week. That will save you a lot of time as well. The next success story I want to share with you is Daniel. He is a banker in Vancouver. He has been studying finance and is a CFA. He couldn't figure out options and earn a higher return. After he went through the program, he made 38% from Activision and Blizzard in 4 months. He made 70% from Intel in 5 months, and he made 61% from Johnson & Johnson in 4 months. So you can see his testimonial here. Daniel is actually a very active student in the community as well, and he has way more successful trades than these. If you go to the review page, you will find a lot of the success trades I posted there. The third part is the Facebook community. That's where you get to join and participate in the community, and you can see other people sharing their results as well. Here you can see that Yves made 22.5% from Activision and Blizzard. And you can see that Arian here shared his analysis on NVIDIA. It's quite detailed and it tells you exactly which strike and option price he's using, which is great. Let me introduce you to Arian. He's an aerospace engineer in Canada. Previously, he wasn't sure if he can master investing in stock options, but he has been actively learning and reading books. But he couldn't really pull the trigger even from reading books until he joined Investing Accelerator. Afterwards, he made 72% from Activision and Blizzard using stock options, and he made 110% from NVIDIA in 6 months using stock options as well. And Arian is actually my third student making over 100% return. And he made 93% from Align Technology in 3 months using stock options. So you can watch his testimonial here. If you're wondering, in this screenshot, this is the trade where he made 110%. Another case study where my students actually shared the dollar value of what he made. So Yves from New York made $17,000 from Activision and Blizzard in 3 months. He invested in Activision and Blizzard for 3 months, and the stock price increase during that time is only 11%. But because he learned how to use stock options, he's able to multiply his return, and he got 22.5% return as overall. On the right-hand side, you can see he made 20% from one of his first position and 25% from his second position. So in the last 4 years, there are 677 successful exits. 138 students made over 30% from their first investment. 37 students made over 100% from a single investment. And almost 3 hedge fund managers has been born in this program. 3 success factors of Investing Accelerator. Step-by-step video coaching program. This is a hands-on video coaching program where you implement the techniques as you go with a lot of examples. Weekly coaching calls for ideas when you're investing in stock. If you don't have ideas, just look at it for the latest ideas. And a Facebook community where it provides you with a lot of support. What if you have a full-time job? Stacy is a consultant manager that works 60 to 80 hours a week. Mary is an accounting manager that works 50 to 60 hours a week. Carolyn, controller, works 50, 60 hours a week. John is a government worker. Preena is a doctor. Flo is a lawyer, aerospace engineer. Daniel is a banker. Julie is an entrepreneur. Craig is a graphic designer. Everyone in the program that are not retired have a full-time job. If you have a full-time job, I'm sure you can do it as well, because I did it when I had a full-time job. I'm sure that's not going to be a problem. Who is this really for? Full-time professionals who are planning for retirement or early retirement, people who want to master investing and get results ASAP. You have a return less than 30% and you want to get 30% return, and you need to have at least $10,000 to invest. If you know you need to get 30% per year and you want to accelerate your goal to retirement, then you can apply to join Investing Accelerator. You can hop on a call with myself or my team by filling in the application form below and schedule a call. Right now, you'll find that there's like a blue button below this webinar, and you can click on that and schedule a call with me. If you are not ready for that yet, then you can stay on this webinar, because we're about to dive into some of the key content I'm about to share with you, the techniques of investing. We'll talk for roughly 45 minutes, and I'll map out an exact action plan for you to follow so that you can earn a higher return this year. This call will probably be the most valuable 45 minutes you spend working on your portfolio. And I'll ask to see your portfolio as well, because I will look at some of the trades you're doing to see if they're good or bad, and potentially telling you what you can do to adjust and basically improve your current situation. Make sure you send me that information, because if I don't even look at your portfolio, then I can't even understand where your mistakes are and how you can improve. If you want to book a strategy session with myself or my team, then it's 5minuteinvesting.com/book strategy session. So the button is down below as well. Right now, there are 200 people on this webinar, and my schedule can only handle around 25 calls or so in the next 7 days. You can apply now. And here are some of the excuses that people tell themselves because they're hesitating. I don't have a brokerage account set up. Don't worry about that. I'll tell you which one to use. I can't commit the time to learn. Well, if you can't commit the time to learn and plan for your retirement, then how are you going to retire? I think you need to commit the time to learn, or else you wouldn't be able to speed up your retirement and achieve your goals. I'm not a finance guy. That's fine, because I'm a CPA, I'm the finance guy, so I'm here to help you. I'm scared of the market crash. In the program, you'll learn 2 techniques on how to deal with market crash. Every week, we'll also analyze any major events to see if there's a potential market crash. Then we can reduce our risk accordingly. We'll cover that in the program. There's no guarantee in the market. Yes, the market is actually quite volatile. There is no guarantee. That's why as an investor, you need to learn how to find great companies and find them at a discounted price to protect yourself. That is really the best you can do, is to find great opportunities and reduce the risk as an investor. I want to get a better feel of your program, which includes seeing some lessons and historical weekly coaching call. That's what we're going to be diving into next. This is what's coming up. First, you're going to be going through the technical analysis video in Investing Accelerator. This will help set up your charts and teach you how to read the most 2 important indicators to help improve your entry. So this is quite valuable. After you learn that, you'll go through 2 historical coaching calls. The first one is the September coaching call, where we analyzed the oil and gas shortage right before winter. This is actually my Suncor position where I made 100% during 2021 winter. Make sure you pay attention to the Suncor analysis. I think my final exit is closer to 120%. This is the one where I use stock options as well. For February 2022 coaching call, I analyzed the interest rate increase and which sectors are important. Make sure you go through that as well, especially if you want to figure out what to do for 2022, how to think about interest rates and the stock market. Within these two coaching calls, you will also find a series of stock analysis examples in the coaching calls as well. You'll learn a lot from it, I'm sure. When you feel comfortable and ready, then you can schedule a call with me or my team to be part of the program. So you'll go through the interview process first. We'll look at your situation, develop a tailored, personalized plan that you feel comfortable in, and then we'll go from there and make it happen. Welcome back to Investing Accelerator. In this module, we're going to talk about the overall approach in terms of investing and also setting up your chart along the way. This is when I'll introduce you to the very first tool, which is our charting tool, and it is free. Now, as of this point, you should have gone through the mindset module. You have started to open your account, or you have your accounts all set up, and you have set up your list as well. I'm very excited for you because this is really the first step into the investing journey. The overall approach has 5 steps. The first step revolves around technical analysis, which stands for analyzing price action and price patterns. This actually acts as the filter to basically eliminate any stocks that is not ready to be invested yet. In this step, we look for stocks that are on a discount, and if it is not on a discount, then we just skip over it. The second step is fundamental analysis. Once we find a stock that is on a discount, we'll dive deeper into the financial statements, the performance of the company, to see whether it is actually a good opportunity. We'll also supplement that with ratio analysis, insider, and news. What we're doing here is really trying to paint a full picture of what is going on with this stock and the market as well. By the end of the 4th step, you'll be 95% confident to invest in this stock, or you think this stock is not good enough and you're going to look for another opportunity. If you decide to invest in this stock, then you'll figure out how to buy options, which is the 5th step to multiply your profit. Now, we are going to set up your chart. There are 3 steps we're going to go through. The first one is we're going to make an account in tradingview.com, which is our charting tool. You might have a charting tool of your broker, or you have a preferred charting tool somewhere else, but this one is free. This is the best charting tool I have seen. Now, I'll also share my chart link with you here. You will see the link down below this video as well. You can see what the chart is supposed to look like. Finally, I'll set it up with you step by step within this video. So we can get started. Let's make it simple. First off, type www.tradingview.com and go to this main website. Now, when you get to this website, you're going to see that there are a lot of things going on. But the first step is really to click sign in. Or if you see on the right, you should see join for free or something. Now, if you click on that, you'll actually be able to start now here with basic. If you see the join for free button, then you can also log in as well. Now, if you don't have an account yet, then you actually can click sign up, and then you can sign up through a variety of means, whether you're using your Google, Facebook, or email. Once you sign up, you'll get a confirmation link in your email. You just click confirm, then you should be logged in. Now I have logged in, and this is my test account. Right now, you're going to see there are a lot of things going on, a lot of things that are ticking. What's important is that first, you see that there's some sort of news feed or chart feed going on in the middle. You see that there's a watch list, something detail about the stock, and also some news. If you look here, the bar, you'll find ideas, markets, scripts, screeners, streams, broker, and chart. The most important one is the chart. That is basically the key function we're going to use from TradingView. We're going to get other functions from other websites in terms of news and financials and so on. Right now, just click on chart, and this will bring you to your chart. If this is your first time setting up your chart, it's going to look something like this. If you already have an existing template, then it will look slightly different, but I'll set it up with you from scratch. As of this point, if you look at your own URL, this is actually your chart URL. And you'll see that it's tradingview.com/chart/this unique code, which is your chart. If you want to bookmark this page, you definitely can. If you actually take out this latter part of the URL and go like www.tradingview.com/chart, you will get to your chart as well. Here it actually brings you back to this chart. Now, if you want to take a look at my chart, just to show you what we're trying to get to, you can click on the link below and let me open a new tab. This is the chart we're trying to get to. Right now, you'll see that it is a view-only mode. You actually can't edit this chart. This is what we're trying to get to. And you'll see that there's a lot less going on. It's much cleaner, and it gives you exactly what you need in order to identify an opportunity or not. In the later videos, I'll actually explain what each of the lines mean, so don't worry. If you're using a free account like I am, then you want to go through the step-by-step instruction to set up your chart. That was one of the first modules of Investing Accelerator where you learn how to set up your account. Next up, we have 2 video testimonials. One is Florence, a lawyer from Australia, and another one is a banker from Vancouver, Canada, Daniel. We can hear what they say about Investing Accelerator.
Hi, my name is Flo and I'm from Sydney, Australia. I'm currently working as a lawyer in the city, and I joined Investing Accelerator in April of this year. And it's been a short 4 months, but it's been a really, really eye-opening journey for me. So before jumping into that, before Investing Accelerator, I was mainly just focusing on finishing my law degree, but I decided to start investing last year. I bought another course that I felt would help me along my way to my financial freedom, but it was actually really time consuming, and I felt that, well, for the amount of effort I was putting in, the returns wasn't that great. So earlier this year, I looked for another investing course, and luckily I came across Eric's content on Facebook and YouTube, and I decided, well, such a passive approach and such great returns, I thought, why not try it? So I did, and in April I joined the course, and in mid-May I made my first investment in Activision Blizzard, and I actually sold half of it last week at a 60% profit, which I'm really happy about, and the other half I'm still holding on to with a 70% profit, and the whole portfolio as a whole is sitting at 40%, and it's only been 4 months since I started my investing journey with Investing Accelerator. So it's been really wonderful, and the investing side of things has really fit into my life really easily, considering that I work full time. I don't have a financial background at all, so for anyone that has doubts about whether they can learn and understand content, you shouldn't be afraid. So I'd say for anyone looking to join or interested in investing, I'd say go for it. Don't hesitate with Eric's course. It's the real deal. The amount of support and that you get with Eric and the community is great. And no question is too silly. We're all here to learn, and it can really change your life. And I'm just really excited about the future now with my portfolio, and I'll see what happens.
Hi, my name is Daniel. I'm from Vancouver, Canada. I currently work at HSBC, and I do MI reporting for their retail credit department. Before joining Eric's team, or Eric's program, I was always involved with investing, but The Investing Accelerator program and Eric has helped me to increase my returns and also improve my investment results. I really enjoy working with Eric. He's a great guy, and he produces results and gives you the confidence in order to place trades and make good investments. Prior to joining, my investments were doing okay. They were making money, but after joining Eric's program, I was able to increase my profits a lot faster. Eric gives you the tools and knowledge and helps with the confidence and the analysis so that you're able to place the correct trades, and by doing so you're able to bring in profits faster than you would without his help. One of the great things I love working with Eric is just his support, and placing trades sometimes can be quite difficult, and placing investments and making investments, and sometimes it takes a little bit of courage. And so Eric's great because he's always there, and his weekly coaching calls, he addresses a lot of the questions, and so any issues or concerns that you may have with your investments, he's always there looking out for you. So it's like having that safety net below you before you take the leap. You can be confident that your investments will turn out well because you have that second person behind you. After joining Eric's program, I've cashed in on one investment so far, and that was on Activision. It's made about a 38% return, and I was holding that investment for about 5 months, so just under 5 months. So I made 38% return in 5 months, which I think is pretty good. It's been better than any of my other investments for that short period of time. If I was to give one piece of advice for a new investor or someone thinking about the program, is just to go with your gut and trust your gut and the analysis that you've done. That because you've done the analysis, you don't need to hesitate. And just for myself and my personal experience, hesitating on a few of the trades and the investments have costed me some profit, especially after doing the analysis with Eric. Just the hesitation has caused me to be late in some entries, or not even being able to take an entry because the stock already moved in my favor. So trust the system, don't hesitate, and invest wholeheartedly. That would be my advice to anyone thinking about the program, or anyone who is investing, new to investing.
First of all, you'll see that at the bottom bar, there are some E's and D's. So this stands for earnings and dividends. We actually don't need that. We're going to right-click and uncheck dividends, right-click, uncheck splits, right-click, uncheck earnings. So first off, we clear the bottom bar so it looks cleaner. Now the next thing you see is that on the upper left corner, there's volume. When we're investing, we actually don't need to use that. We can get rid of it as well. Then we can actually start modifying this chart. If we right-click on the white space, then you can actually get to something called settings. Right now, we're going to change the outlook of the chart. Here, you're going to see body, which is under symbol. I'm going to use a white candle for up and a black candle for down. That means I'm going to choose white here. You see that the green candles turn white. And for the red one, I'm going to choose black. This is really just what the industry standard is. What I personally feel like is cleaner. Here, I'm going to choose black for borders and also wick. This should give you a fairly clean chart. Once you have finished modifying the chart colors, you should see that it changes in real time and it looks like this. Then afterwards, we'll go down to status line. And I think we can leave this, not worrying too much about it. We can go to scales. We can keep that as well. And once we get to appearances, you will see vertical grid line and horizontal grid line. This is actually something we don't want because we want our charts to be simpler and less clutter. We'll change the color to white. Now you can see that the background is completely cleaned. And in terms of trading, since we're going to be using our own brokers, we actually don't need this at all. So we can deselect positions, orders, and we don't need to show execution as well. This one is kind of important, show buy or sell buttons. You can uncheck that as well. If you uncheck it, on the upper left-hand corner, this should disappear as well. In terms of events, I think we cleared that out earlier. Here you also see show economic and events on chart. You can actually deselect that as well. So in the end, you have a very clean chart with just black and white candles. Now it's time to add our indicators. If we go up here, you'll see the symbol. For example, right now is Apple. Then you're going to see a D, and this stands for the time frame of your chart. I'll explain this in a little bit more detail in the later videos, but basically each bar you see here stands for 1 day. When we are investing, we want to take a long-term view. We want to use 1 week. And this is pretty much the charts we're going to be using throughout the entire program when we're investing as well. If we click 1 week, this is really the charts we're looking for in terms of the time frame. I don't recommend using any charts below 1 day. So personally, I just use 1 week alone to invest. And I don't use any chart below that because it is too volatile. The lower the time frame you go, the less reliable the chart is. So 1 week is what you're looking for. Now in terms of candle, or in terms of this little button, it gives you different types of charts, like bar, candle, hollow candle, line. We're mainly going to stick with candle. That's pretty much all we need. And afterwards, for compare, you can just skip that. For indicators, that's what we want to add. We click on indicators, and basically, we're adding 3 indicators in total. For the first one, you can type BB, or Bollinger Band, and you can see it right here. You just click on it once, and then you will see the Bollinger Band showing up. On the upper left-hand corner, you'll actually see BB as well here. So that's how you know you have added one successfully. The next one we wanted to add is really EMA. This is really the short form called EMA. The long form is actually called Moving Average Exponential. So in the past, I used to be able to type EMA and this will show up. But now you actually have to type the full name, Moving Average Exponential. For this one, you want to click twice. So you will add 1 EMA and you will also add a second EMA. So here on the left-hand side, you'll see that there are 3 indicators now, which is 1, the BB, 1 EMA, and another EMA. At this point, we are good. And now we need to customize these individually. When you go to the BB band, you're going to see that there are 4 buttons, which is hide, settings, source code, and remove. There's also one that is more. But basically, if you click on hide, then you can actually hide the indicator temporarily. We'll be using that later on for the technical analysis videos. For this one, we really want to just click on settings and just clean it up a little bit. Right now, you'll see the input is 20 in terms of length and standard deviation as 2. So that is what you're looking for, which is just the default. In terms of style, you're going to see that everything is currently checked. So basis, upper, lower, and background. We don't need basis, which is actually the middle line here. I just unchecked it. This is the middle line. And then we also don't need the background. I'm going to uncheck that. What you're going to get is the upper and the lower blue line as BB. I think we're happy with that. So we're going to click OK. Now afterwards, then we want to customize the EMAs. We click on settings again here, upper left-hand corner. Right now, you will see that the style is blue. For this one, we really want to customize it to 100 EMA and make it red. So I'll choose red. In terms of the line, I think a line is fine. What I really want to choose is the thickness. And the thickness, I want to choose the 3rd level. That's usually thick enough. You can choose the 4th level if you want to, but 3rd is good enough to see. Afterwards, in terms of inputs, we want to change the length to 100. So on a weekly chart, this means you're looking at the exponential moving average for the last 100 weeks, which is approximately 2 years. Then you click OK. So then you see that there is this line right here. Afterwards, you can go here and click on settings again for the second EMA. And this time we want to do 200. This means the last 4 years average in terms of this chart. And in terms of the color, we use dark blue. So we can use that one. And for thickness, we will choose the third one again. You can actually use a darker blue if you want to. So that's just personal preference. As of this point, these are all the indicators you need, which is the last 20 weeks for Bollinger Band, 2 standard deviation, 100 EMA, which is the last 2 years, exponential moving average, and a 200 EMA, which is the last 4-year moving average. In the later technical analysis video, I'll go through these indicators one by one so you'll know exactly what to do with them. Right now, I'll just explain a little bit more about the user interface so that you know what everything is. In the upper right corner here, you're going to see that this is unnamed. It might be something else for you, but what this is the name of the template. We can actually rename this template to be something called Investing Accelerator. So then you can click Save, and you can see that the name is now updated. And you can see the cloud has a little circle around it. But then every time you click on that or you make a change, it will actually save. Make sure this is checked once you exit the chart. Then it will save all your progress, all your analysis, all your lines as well. Now on the right-hand side, you're going to see a watch list. If you look to the rightmost bar here, then you're going to see there are a lot of little icons. So most of the icons we're actually not going to use. For example, like alerts, data window, these other things. We actually don't need any of it. You just got to click watch list, which is the very first icon. You're going to get a pre-populated watch list from TradingView. Now in the previous video, we already covered what your watch list is going to be. We actually don't need any of the pre-populated stuff. What we're going to do now is actually to take this out. You see this little X button here on the right? Just keep clicking on that until you get rid of all the stocks here. Now you have a clean list. And what's important is that you put in your stock symbols into the watch list. For example, I can type FB, which stands for Facebook. Then that is added. And I can also type AAPL, which stands for Apple. That is added as well. If I click Facebook, then you can see that it actually just goes directly to Facebook. And on the upper left-hand corner, it is Facebook as well. If I click here, Apple, then this is goes directly to Apple. Now you can pause this video, take a minute, and add all the stock symbols you found earlier into this watch list. You should have around 10 stocks to 20 stocks to be added here. Now below here, you'll actually see that there is a very small card of what the stock is about. For example, the price for Apple. If you go down a little bit, it will also tell you what's happening on whether the market is buying or selling the stock. You don't want to look at that too much because most of the time you actually want to do the opposite of what this little card is telling you, and you'll learn how to do your own analysis, so then don't worry too much about it. You can see that there is a little bit more stats here, but you actually don't need this card. At the bottom here, you'll get some headlines for Apple. This is actually quite useful. When we go over the news module, then we'll dive deeper into how you can read news and use that to your advantage as well. But that is pretty much it for this video. Now you can add the stocks onto your watch list, and I'll see you in the next one. Now you have gone through another module of Investing Accelerator, where you learn how to read the chart. And it's really important for you to schedule a call. You can click on the link below and go to 5minuteinvesting.com/book strategy session. Find a time that works for you, and then remember to fill out the survey so then your application is complete before the call. So next up, we have another 2 reviews, and these 2 are both engineers. One is Benson from Vancouver, Canada, and another one is Arian from Ontario, Canada.
Hi everyone, my name is Benson. I live in Vancouver, Canada. I am an engineer working in the software industry. So before I joined Investing Accelerator, I did not do any investing, but as I started working and getting more income, I felt the need to start doing some of my own investing and making my money grow. I had no idea how to start, so I was very new to investing. I wanted to invest in stock. So my friend Eric, who is the founder of Investing Accelerator, He was the one who taught me how to invest, how to look at the charts, and how to find a good stock to buy. He put all his knowledge in Investing Accelerator, and I took that program, and it taught me how to properly do research in the stock market and to risk assessment of all of the stock that I wanted to buy. So after joining Investing Accelerator, I made over 100% return in some stock that I purchased in previous years. I have become much more knowledgeable in analyzing the stock and how to read the charts. I know how to research on the stocks to buy now, and I know how to research in the stock market. One advice that I would give to the new investors that want to join this program is to focus your investment in companies or industry that you know and are familiar with. For me, I was more familiar with the tech industry because I work in that tech industry. So majority of the stocks that I purchase are in the tech field. If you don't have a field that you are familiar with, that is fine too. After joining the program, it will teach you how to properly research on the stock, and you will be able to find a field that you'll be familiar with. And that's it. Thanks for listening.
Hello, my name is Arian from Montreal, Canada, and I'm an engineer at an aerospace company. And I'm here to talk to you about Eric's Investing Accelerator program. So before joining the program, I've never invested before, but I've read books and taken many online classes. So from what I've read and what I've learned, I really like the aspect of long-term investing and also the option side of it. So when I stumbled upon Eric's program, I thought it was really perfect for me. So after going through the program, it gave me enough confidence to basically invest in my very first stock, which is ATVI. So I entered in March and exited not too long ago, September. And I pretty much gained 71%. So it's really exciting. And I'm really thankful that I have gained this knowledge. So thank you, Eric. So just a piece of advice for everyone that's just joining in. So I would say be consistent with your analysis, be thorough, don't skip any steps, trust the system that it works. Also, go through the coaching calls and get into Eric's mindset of analyzing the stock. So that really helped for me, and that's it. I think enjoy the process, and good luck to everyone. Bye.
Welcome back to Investing Accelerator. In this video, we're going to talk about the exact signals to look for to identify strong growing stocks. If you followed the previous videos, you will be at this point in time where you have the indicator set up, you'll have an account, and the chart will be in the correct format. If your chart do not look like this right now, and you're not using the weekly chart, then make sure you go back to those videos and follow along. Right now, there's no stock in the stock list. And in an earlier module, I taught you how to build your own stock list. If you already built your stock list, then you can start typing in these stocks into this list. But if you have not, then go back to that module. For this example, I'm going to add a few stocks that are currently on my stock list. I'm going to add United Airlines, Southwest Airlines, Google, it's actually Alphabet, Apple, Starbucks. Okay. This watch list you have on the right, we go in depth in an earlier module in Investing Accelerator. Make sure you only add the stocks that you know, you like, you trust, and you're a customer of. Now, in this video, we're going to go through how to identify strong growing stocks. In this case, I'm going to explain the indicators one by one. In this video, we do not need the Bollinger Band. So for the purpose of this demonstration, I'm going to hide it. So now I only have two indicators, which is a 100 moving average and a 200 moving average. Now what do these represent? The blue line, the 100 moving average, is the average price of the last 100 weeks, which means 2 years. This is a 2-year average. For the red line is the 200 exponential moving average, which means it's the average price of the last 4 years. One is 2 year and one is 4 years. These are really long-term moving averages. If you want to identify a stock that has a good trend, the price represented by these candles should generally be above these two lines. You see that the price is generally above these two lines. Now sometimes it might dip below these two lines temporarily, but that is okay. This is United Airlines, a very clear uptrend. Second example, Southwest Airlines. Here you'll see that the price is generally above these two lines. Now for Southwest, it doesn't even touch the red or the blue line. That is pretty good. A very clear uptrend. The next one, you'll see that, again, a very, very nice uptrend. And it's very clear, and these are the type of strong, stable companies that we look for. The next one, Apple. Again, a very strong, nice uptrend. Okay? So generally the price is above the red line. Starbucks. Again, a very nice, stable uptrend. Okay? Hopefully we have gone through enough examples for you to realize that how to identify a stock that is in an uptrend. Here, I'm going to give you an example that a stock is not always in the uptrend. Here, you'll see Twitter. Twitter hasn't been IPO'd for that long. It was IPO'd back in 2014. You will realize after 2 years, you will get the blue line here. And you will see that the price is below this blue line. That is a downtrend. The trend changes when Twitter goes through this red line on a permanent basis. For a company like this, we would avoid it from 2014 to 2017 because it's in a downtrend. Why do we avoid companies that are in downtrend? Because over time, the more you hold it, the more it is against you because the company is declining in terms of stock value. Now, I know a lot of people are interested in investing in turnaround companies. Basically, people think that certain companies, have a restructuring event, and basically the new strategy will allow the company to turn around. What you would do is you would try to look for a bottom in a downtrend. But the problem with this approach is that the odds of a restructuring succeeding or the odds of the company turning around, it's quite low. Usually, let's say is 1 out of 10. So 10% of the time. So you might look at this high and you'll think it continues, but in fact, it would go down and down and down. So if you just count the number of tops here, 1, 2, 3, 4, 5, 6, 7, 8, you will realize all these are fake until this one, the 7th or 8th top, that Twitter has successfully turned from a downtrend to an uptrend. And that's why we don't invest in turnaround companies, because the odds are not in your favor. Let's look at another one, AMD. In this one, AMD right now has a significant change in trend. If you look back in 2010 to 2016, you're going to realize that AMD is consistently below these two lines. In fact, it started to be below in 2007. You'll see that there's really not a good opportunity to buy it because the trend is against you. Generally, it will go down and go down, or it will just hover and it will go down. You really want to avoid stocks with price that is below these two lines. The company only really changes in trend once it passes the red line. This is when we start to look and pay attention to these companies. When you add your stock list into tradingview.com, you want to take a look at the trend and basically eliminate any company with a downward trend, or you just want to move them to the bottom. What I do on a weekly basis or every 2-3 days is I would go through my stock list and I would look at it like this. I would see if there's an opportunity or if there's a stock that might be ready soon, and I'll move it up and down this list so I can actually drag it and reorder it. So over time, the best opportunities will always be at the top. The worst opportunities will always be at the bottom. Sometimes I might even delete a company or two off my stock list. That is how you identify companies with a strong trend. In the next video, we're going to talk about how to find companies at a discount. Once you've identified an opportunity when a company is at a discount, then we'll start doing our research. Now you have gone through the technical analysis module of Investing Accelerator, and that really puts you ahead a lot of investors that try to use technical analysis but couldn't figure it out. Up next, we have Caroline from Vancouver, and she's actually a controller, and previously she was day trading, but she wasn't very successful. I'll also walk you through one of my recent successful investments in electronic arts. Now, when you're ready, there are a couple of spots left for you to book a strategy session. You can have a personal one-on-one call with me and to understand whether you're a good fit for the program. There are a couple of spots remaining in the next 7 days.
Hi, my name is Caroline, and I'm from Vancouver, British Columbia. I joined Investing Accelerator last year in October 2018, and I started my first trade with Facebook options when there was a huge drop, and I entered my first position in November 2018. I just closed my options trade last week in May 2019. So within 6 months, I made 79%. And I'm super, super excited about not just this trade, but the potential of many, many trades that is to come. My life prior to Investing Accelerator was in Forex, shares, and also options. I was into doing short-term trades as well as daily trading. However, it was a huge stress for myself. I also hold a full-time job as well as trading in the evening and early in the morning. For the efforts that I have put in, the return was not significant. That was my life prior to joining the Investing Accelerator. After I joined the Accelerator program, I realized that sometimes you can still make a decent, in fact, a very, very good return without engaging in frequent trades. And when you have a peace in your mind, and you will be able to see the opportunity better. And the most important element of trading that people do not notice at times is the time. You need to let the time to do its job. And for the short-term trader or the daily trader, they thought that they can get in and out of it and have so much stress in their life and might even encounter health problems for some of my friends. So I'm super excited that I joined this program and learned all the skills that Eric taught and be able to carry it through. After I placed the trades last year, although the trades was not doing too much initially, but my stress level has also not been so high. And when you give the time into consideration, after 6 months, your investment will be realized. For myself anyway, sometimes it might take longer than 6 months, sometimes it might be shorter. But overall, I'm super happy, and thank you, Eric, for such a wonderful course. I give this rating a 5 out of 5. Definitely for anyone who do not want stress and anxiety in their life, and simply let the time and let a good investment run. Thank you.
In this video, I just want to walk through one of my successful trade, kind of explain, what happened and how to think about it and what is the results so far. The stock we're currently looking at is Electronic Arts, and it is a gaming company. It has quite a few good games, or some people might disagree, but it has a lot of brands under the company's belt. If you look at this chart, and let me just hide all the indicators here for you, just to give you a feeling of what I did. I entered here near around $82, $86. Afterwards, the stock just went up for the next 14 months. Right now it's $110. I took my second profit. As you can see, there's like this huge drop here, which caused a great discount. After doing research in the company, which I'll explain further, I got in at this price, which is quite a good price when you look at it historically. The price has been going up above 100 and so on. In terms of stats, here's the stats. I entered at around November 2018. My second exit is January 2020. As I'm recording this video for you, it's actually just this week. My return on the second position is actually 63.4%. In terms of dollar amount, I realized $6,212, and this is what I took in terms of profit alone this week. I also exited a little bit earlier, which is kind of around here at around $106, and my profit is $3,518 last month, which is when I took the profit. And I also have an unrealized amount, which I'm currently still holding on to, of $7,763. In total, my gain for this stock is $17,493. I gotta say, for the amount of capital I invested in, I earned around 50-60% on this. The gain is pretty good. So how did I make this trade? What made it successful? And how can you potentially repeat it for yourself? I'm going to try to cram a lot of concepts within this video and just explain this trade alone. Of course, if you want more details, you can go into the description and there's more details there. When you look at this stock, EA, it's a very strong company, it's blue chip, it's basically #1 gaming company in the world. But during that time in 2018, there was a lot of bad press. A lot of people are unhappy with the company, and there was regulation impacting the company because of the whole loot box problem. And I think Belgium at that time was banning loot boxes and basically saying that it's not allowed anymore because of people spending so much money on it. And the stock price just keeps going down and down and down, and everyone is basically hating on EA. But that doesn't change the fact that EA is fundamentally a very strong company. It doesn't change the fact that when you do your fundamental analysis, you will find that EA is growing. And it doesn't change the fact that when you compare EA with its peers, other gaming companies, it is considered to be undervalued. So, that's what I really talk about in my coaching program is distortion, manipulation, and basically disastrous events. This is a very good example of it. If you take some time and research during that period, you're going to find a lot of bad press for EA during that time. But it doesn't change the fact that when you start doing your fundamental analysis and so on, EA is a great company. That's how I got this kind of return, by investing at a dip. Afterwards, it's pretty passive. Once you enter at a good time, once you find the right company, once you wait until it is a good time to enter, it's pretty much hands off from there. You might wonder, the stock price went from around $82, $83 to $106 to $110, right? If you calculate the return is actually not that high. So 106 divided by, let's do 111 divided by around 83. It's only a 33% increase in terms of absolute dollar value. How come I'm able to make 63.4%? This is really where the magic comes in. And the magic is stock options. I use stock options as a way to multiply my profit. Now, stock options is not a very popular concept. Not a lot of people know about it or use it effectively even. But if you know how to use stock options effectively, which I would consider this to be an advanced topic, then you can use it to multiply your return. That's why I can get such a return. That's actually how I executed this trade. Right now, obviously, EA is performing very well. You can see the stock price is going up. It's releasing new games. One of the more notable games is actually Star Wars Fallen Order. I personally bought it and I have been playing it. I've been enjoying it. I think, it's a great game. I think that is one of the reasons why the stock price is going up. I also think that the upcoming E3 conference is like a driver that caused the stock price to go up as well. That definitely, plays a part of it. Now you'll notice I'm talking a lot about the qualitative side of things, how the news is impacting it, how the regulation is impacting it, how upcoming events might be impacting the stock price. I actually combine this with technical analysis and fundamental analysis. And it's really powerful when you are able to combine multiple analysis together and then use stock options to multiply your profit. I think this is a really good case study because obviously there is quite a good profit here. I've already profited around almost 10K here, 9.7K. I have another 7 to 8K that is still currently unrealized. We're just waiting to see if EA will go further up. Now you have gone through a couple of modules of Investing Accelerator. You are already ahead of the average investors in the market. And you also have seen multiple testimonials of people without financial background who succeeded in the market after taking Investing Accelerator. So the next couple of moments, I want to give you a sneak peek of what it is like to attend one of the weekly group coaching calls in Investing Accelerator. In these coaching calls, we actually go through stocks in detail. We answer any questions you have. We have this coaching call every single week. When you are ready, click on the button below and apply and book a strategy session with me in order to see whether you qualify to join the program. Once you click on the link below, you can find a time that works for you and then complete the survey and submit the documents. Now review your application to see if you're a good fit. There are only limited spots available, so then you need to apply now so we can chat in the next couple of days. Welcome back to September 25th, 2021 weekly coaching call for Investing Accelerator. For this week, the list of disasters, we have a quick update in terms of the gas shortage in Europe, and US is expected to open travel in November. We're also going to talk briefly about the China Evergrande issue and how they're bailing them out. Then we're going to talk about a few quick Investing Accelerator updates where I added 2 new features. In terms of stock pick quick updates, we're going to talk about Suncor, airlines. Kelly requested a quick update on MasterCard, Visa, and GPN. Afterwards, we're going to briefly go through these ones as well, the medium risk stocks as well. In terms of deep dive, we have FedEx, Nabil EA, along with Take-Two and Activision and Blizzard. For Felix, it's just a quick update on Amazon Care and TDoc, which is a stock we covered previously. I'm also going to talk about some of the hedging positions that I currently have, which is for ACSU and Kirkland. Finally, I'm also going to talk about Disney because they have a slowdown in production, which led to a drop in stock price. Here's a summary analysis, and you can refer to this, or you can just skip ahead to the stock that we're going through. First of all, right now, the European countries have a shortage of gas. Oil and gas prices are at a high. Let me just show you the chart. So here, this reflects US oil, which is at around 60 to 70 something dollars per barrel, which I think is expected to go higher. So at this point, OPEC is planning to increase supply in the near future, but I don't think they'll be increasing supply fast enough to keep this price steady. Chances are it is going to shoot past 80 this coming winter. We'll just observe how that goes. Why is this important? This is important because gas companies will benefit from the commodity price increase. Recently, we have a position in Suncor. Here you can see since then, Suncor has been going up this week. I think as the European gas prices increase and the shortage worsen, this will continue to go up. I think it is still okay to enter as long as it is below $21. After $21 US dollars, then don't chase Suncor. Now, if you like other oil and gas companies like ExxonMobil, you can also see there is an uptick. Shell, which is RDS.A. So you can see there's also an uptick this week. This is more than just a Suncor increase. It is actually an overall increase for the entire industry. I think it's a matter of, you look at the financial, which one is growing the best, has the lowest dividend, has options, and also has insider buy. In this case, I selected Suncor as the investment. But if you want to select another one, like for example, Shell, that is based in Netherlands, or BP, which is based in UK, then that is something you can look into. I would say generally oil and gas companies, they usually have a flat trend or their dividend is high or their growth is not as strong, just make sure you do that research before you invest in them. It should benefit from a reopening of COVID, which has a higher demand on gas prices. Higher gas prices because OPEC is restricting the supply. Russia has a very low volume of inventory as well. Winter, there's also a very high demand for gas, and China is also using a lot of natural gas as well. So that is going to keep this commodity price quite high. So that's what this is for. The next one is China provided 18 billion liquidity to Evergrande through banks. Right now, the issue is temporarily on halt. Let me just bring up that article. So when you think about China, they're dealing with a couple of issues, which is tech regulation and also the real estate problem. The real estate problem is really caused by China having tighter real estate regulation earlier this year, which caused the stock price to drop and Evergrande not being able to raise more capital. And they can't openly admit they made a mistake. They can only help Evergrande indirectly through injecting money into the banking system. So far, they injected 18.6 billion into the banking system to help Evergrande. The next article is US is expected to reopen travel in November. Previously, I think the timeline was September, but right now we're almost the end of September already. Right now, they are opening for vaccinated foreign air travelers in November. I think if there is even a slight delay, let's say it's December, I think that's the timeline we're looking at, which is this coming and the next coming earnings for the airline stocks and Christmas rush. Then the financial results should come in January, February. So then if you want to take advantage of that, then you want to invest before the financial result comes out. I think that's where you will see the surge in stock price. Now, at the same time, Boeing also revised their forecast or continue to restate their forecast that Chinese airline will be buying 8,700 new aircrafts by 2040. This is more like a rumor. This is just a forecast, right? There's no hard contracts to back this up. I do think there is a very strong demand from the China side, even though right now they are closed off at the moment, which means they mainly have domestic travel and not a lot of international travel because they haven't gotten COVID under control yet. Nevertheless, because of this rumor per se, you can see Boeing stock prices going up. But let's first start by looking at Boeing stock price. So here, you can see after they released this article, then there is a small uptick here, which is good. For this week, you can see Air Canada is going up this week, bouncing off the lower Bollinger Band, which is great. If you look at something like UAL, there's also a larger increase. This might be the first candle of the bottom ending. Then if you want to enter and you can get in around 48, I still think it is a good price to enter. Once the bottom is complete and it spikes past these EMAs, then you don't want to be chasing anymore. You will see this is actually an industry-wide thing because for DAL, you can see a similar candles being formed. When you're comparing between DAL and UAL, then you probably want to invest in UAL, whether it is lagging a little bit behind, but you're getting a deeper discount. If you want to invest in DAL, I think that is okay as well. Now, some people, I know you like Southwest Airline, and here you can see they're bouncing off the EMAs. This is the first candle indicating the bottom is over. Now, for Southwest, I do have some reserve over it because the CEO is stepping down to become board of directors in February. I think that is probably the main concern. So let's say it goes up by a couple of months, which you'll probably be able to make a good profit at this stage. By February, there's probably going to be some panic around a new CEO, and then it will come down again. That's my expectation for Southwest, versus where I think it wouldn't have that issue for Air Canada or Boeing as well, which is why I have these two instead of Southwest. Okay. What I just did was I actually covered this here in terms of quick updates. Now, the next article is actually Disney is showing slower user growth. Then I actually have Disney as a stock pick near the end of this video, then we'll cover that by that time. Okay. First, let's talk about Suncor. This is a stock we covered August 12th, and I talked about the US oil prices at a higher demand due to economy reopening. The bottom is basically complete unless there is going to be a second part of the W, which let me show you what I mean. So here is Suncor. You can see the Bollinger Band is expanding, right? Which is one of the red flags I told you about, which is why we bought a put protective position in case there is a W forming later on. But in terms of the first part of the W, you can see it should be going up for the next couple of weeks. And with the macroeconomic environment also being very positive for Suncor, we'll be taking off Suncor off the quick update. Basically, the next time we cover it will likely be the time to exit. Now, the next one is airlines. We talked about this earlier, and basically, I think the bottom for the airline is almost complete or basically complete, according to this week. And going forward, if US is also reopened to Europe and Canada as well, then the financial results should reflect that, which means they will be back to 100% utilized soon. All right. Once the airlines spike, then I'll be taking this off the quick update as well because the entry zone is complete. Now, next one is Kelly. So you're interested in entering either Visa, MasterCard, or GPN, which is the payment stocks. If you look at Visa and MasterCard, historically, you don't really get that much discount. I think you also included AXP here as well, which I didn't enter. If you look at AXP, here you can see it is at an all-time high. I wouldn't chase AXP for now. I think instead you can look at Visa and MasterCard where the formation is more similar. Between the two, I think MasterCard right now has a slightly deeper discount. If you look at MasterCard historically, you actually don't get that deep of a discount. So if you want to use stocks to buy and hold MasterCard or Visa, I think that is fine. Is a pretty safe play. Now, if you're interested in a stock that has a deeper discount, which is Global Payments, then here you can see it actually dropped between the red and the blue EMA, which usually it does not drop. This is a rare opportunity to enter into GPN. Now, one thing you do note is that the Bollinger Band is expanding. Previously, I think some people try to enter near the blue EMA, and this is an example where sometimes you might get into the position early so then you can lock in the price, but it doesn't necessarily mean the stock price will go up right away. If you think about why you want to invest in GPN versus MasterCard and Visa, it really comes down to whether you want to use options or not. For MasterCard and Visa, it is a little bit risky to use options. You might want to stick with stocks for those ones, whereas for GPN, you're getting a deeper discount. I think there is a better rationale to use options, but you want to wait for a bottom to mature. What you're looking for at this stage is price to hover above the blue EMA continuously for a while until this Bollinger Band lower part is flattening out or curving in. I think that is usually your clue. Basically, it should be kind of stabilized at this 155 to 170 range until the next earnings report come around. That's kind of how I would think about it. If you're using MasterCard and if you're using stocks for MasterCard and Visa, I think that is fine. All right, the next one is Goose. This is also another one I'm watching as well, but I haven't invested in it. Here you can see it is actually hovering within this area. There's also share buyback as well, and winter is also coming. I do expect Goose to be going up, but I just haven't seen the candle I'm looking for, which will give me the indication that it will break out. I'm still waiting to see if it will mature any further before investing. The next one is Intel. For Intel, it is actually forming a bottom, and recently they actually started their manufacturing buildup, or they just start breaking ground to build that facility, which will take approximately 2 years. I think that's quite positive for Intel. Right now, there is still a chip shortage as well. I think if you're looking to enter into Intel, I think this price is okay to enter half your position just to be conservative, because you can see right now the Bollinger Band is flattening and it is okay to use options for Intel. Now, ideally, you want to save some of your money so then you can enter below 50 in case there is any additional bad event that happens. Because you can see for Intel, historically, it does kind of dip below this blue EMA a little bit more than other stocks. That's why I said you want to only enter a portion of your position. Now, there's also another stock that I'm watching, but I'm not as familiar with, and that is MU. I think earnings is coming up next week or so, if I remember correctly, and you can see the Bollinger Band is flattening. I've been watching this stock, but because I'm not as familiar with this company, I probably wouldn't be investing. If there is positive earnings, which is what we're expecting, then it might jump up to around $84 or so. Let me just pull this up. It's going to be released Wednesday. This is coming up Wednesday, so you still have 2 more days, which I do expect it to be going up. The reason is because when you're looking at this trend, they are opening their new facility. They are ramping that up, which means they should expect higher earnings and higher revenue. Here you can see for the next couple of quarters, the next 12 months actually, they expect it to be doing well. For revenue, they're expecting to be going up as well. I think that is really the underlying driver for MU to go up. But having said that, my concern would be they're still insider sell. I try to avoid investing in anything that has insider sell because there's obviously a reason why they're insider selling. And MU is also heavily influenced by chip prices, which is a very competitive market. The next one is Take-Two, Activision, Blizzard, and EA. We'll talk about this when we are analyzing the stock for Nabil here. And the next one is LMT. For LMT here, you can see that this is actually the first week it is rebounding. The Bollinger Band is still expanding. I do think that this is looking like it is a good W formation. Now, when you're thinking about the defense industry, so far Biden hasn't released anything important on it yet, which will make me think that LMT do drop even more. I think chances are it is going to be stabilizing at the blue EMA. I think it is still early. You probably want to watch for a couple more weeks to see that this candle is getting out of this line, the Bollinger Band. So you can see something like this, where it is getting out of the Bollinger Band, so it's not touching it anymore. At that point, I think you can invest if this is something you're interested in holding. The next one is Apple, Facebook, Google, and Disney. These probably don't get you that much discount. Apple has been dropping for 2 weeks because of the App Store lawsuit. Right now it's going back up a little bit, but you're not getting too deep of a discount. So if you're interested in using stocks, then perhaps you can use stocks, but personally I wouldn't be investing in it this time. For Facebook, they also have like a conflict with Apple regarding human trafficking. I think that's why it's going down. When you're looking at the big tech, they are expecting to forecast slower growth in the next 6 months. I think that is also another reason why it is driving down the stock price. For these stocks, if you are interested in being patient and wait for it, then try to wait for the lower BP band at the earliest. If not, usually I wait for a deeper price like the red EMA. For Google, not dropping, is not really on a discount. For Amazon, you can see there is a pin bar in the middle of the Bollinger Band. Chances are, if you want to invest in Amazon, then it will just be shares without any discount. That's just what you need to be comfortable with. All right, so the next one is TDoc, which we are actually going to be covering as a quick update down here for Felix. We're going to skip that for now. Next one is Vertex. So for Vertex, the earnings is actually coming out in early November. Right now, the stock is still dropping. There's actually insider buy, but we haven't seen an upward candle, which will make us think the bottom is forming or has completed yet. You can see the Bollinger Band is actually slightly down. It's not flattened yet. I think it's a matter of waiting. There's no need to jump into Vertex yet. Pins. This one has slower user growth earlier. Right now you can see the stock price is stabilizing above the red EMA. If you want to have a small position, I think you can, because the Bollinger Band is still expanding. I think until the Bollinger Band is flattened, there is quite a high possibility where it might drop below the red EMA, given all the other big techs are forecasting slower growth in the next 6 months. The next one is Baba and Tencent. For Baba, it is really weird, but it hasn't stopped dropping yet. That means the bottom hasn't formed, and you can see the Bollinger Band is still expanding. It's just a matter of waiting. For Tencent, you can see price is starting to stabilize at the blue EMA level. The Bollinger Band is still expanding. I would say the bottom is forming now for Tencent, which is great compared to Baba. So I would still say just wait for it, because there are quite a few issues with China right now. So don't be overexposed to any Chinese stocks. The first stock pick is Shurkesh and Mark, FedEx. It is on a discount now. It is down due to earnings miss and lower forecasts. If we hold this stock for 6 months, is there any chance of doubling your money? I would consider FedEx to be a COVID benefited stock, such as Apple, Facebook, and right now others are expecting a slowdown in the next 6 months. So do you see a general decrease in terms of volume for these stocks? Good earnings is expected to come in June 2022. Right now, you're still early. Keep watching FedEx on a weekly or a monthly basis until it forms a bottom. You want to invest in this as late as possible in terms of bottom formation. Here's the analysis for FedEx. You can see everything generally check out, other than the fact that the bottom is early and there's insider sell. First, let's look at insider. And here you can see it is quite straightforward. It's insider sell with some grants back in June. Okay. Let's look at the charts. Now, previously, FedEx terminated their partnership with Amazon. That is the drop back in here, 2018. And afterwards, it flattened out for a bit, COVID, and then afterwards, it bounced back significantly. So now, as we are coming out of the supply chain crunch, and there's less people sending masks all around the world, then FedEx is seeing an earnings miss and also lowering forecasts. I think that is actually quite reasonable. That's why you see there is this big drop and the Bollinger Band is expanding as well. When you're looking at a big drop like this, the Bollinger Band is expanding, it means that you don't want to be getting in early. So that's why I said track this on a weekly basis until you see a very solid bottom. You want to wait for the stock price to get out of this Bollinger Band area. Chances are, my guess is that it wouldn't stop at this blue EMA, it will probably go even lower. Then once you see a solid bottom, then you can choose to invest in it. Because if you're investing too early, then it wouldn't be as easy for you to double your money in the next 6 months. Try to invest once you see a bottom to be very mature. For example, something like Suncor, you can see I invested in this week, which is way after the drop. You don't need to wait in the market as long. So right now, it is early. Don't invest yet. Now, when you're looking at the financials, on average, FedEx does have a growth of around 6 to 8%, but for the pandemic year, they have a growth of 21%. So I would say this is not a sustainable number. Chances are it will come down after the pandemic is over, which you should be seeing this year because they are lowering their forecast. Here you can see they're making quite a bit of money as well, so I think that's fine. When you're looking at the quarterly, you will see the slowdown here. So from May to August, you see a 10% growth quarter over quarter, and afterwards you see this number is dropping. And if they're lowering their forecast, which means they think it is going to be dropping even more, I think it makes sense that the stock price is dropping for now. Here you can see the profitability is improving after COVID, which is what we expected anyways. Now, when you're looking at quarterly, here you can see the cash is relatively flat. There is sufficient cash, so I'm not too worried about it. If you go down to debt to equity ratio, it's approximately a little bit higher than 2 times, maybe 2 point something times, but I think that is okay. So let me see what I wrote here. 2 times, yeah. In terms of why it is dropping, the first reason is because there's higher labor costs, supply chain issues, and so they miss earnings and they're lowering their forecast as well. I think with a combination of these factors, the bottom should take a while to form. Probably you want to wait until they release another earnings and a little bit more. So in terms of dividend, it is quite low, 1.19%. I think it is fine to use options. If you're wondering when they would have a spike or when the bottom would form, then just look at the next 2 earnings. You can see there is actually a slight decline here compared to these 2 quarters, and they miss earnings here. I would expect wait till 1Q 2022. They do have an off year end. You just got to keep that in mind. This Q2 is actually June 2022. If you ask me, can you make double your money in 6 months? The answer is probably not right now, but if you invest closer to December or even in early spring, I think you might have that potential. That's kind of what you're looking for in terms of when to enter. If you refer to this website, which is just a little bit more visual, then you can see that the earnings is expected to flatten out for the next 2 quarters until this Q4 2022. Because they have an off year end, this is actually June 2022. So you want to invest before this time, but not too early. Right now, you're still on the early side. You have around 6 months where the bottom will form. If you go to revenue, you can see they do expect increase in revenue, not too much, until June 2022. Okay, I think what you want to pay attention to is mainly earnings because that's what they got penalized for last time, which is why the stock is dropping right now. Then for the next 2 quarters, they do expect it to be flat. I think right now it's still early to invest in FedEx, but when the time is right and the bottom is maturing, then you can choose January 2024. So by that time, let's say you're waiting another 3 to 6 months before you enter into FedEx. At that time, I think you can choose January 2024, and then you can choose a strike price by that time. Overall, I would say FedEx is low in terms of risk rating. You would decide to hedge in this case because you're early, but then you don't invest until the bottom is mature, okay? So that's why I put down there is no strike price or stock price here. Just observe it until you see a solid bottom. The next stock is Nabil EA. What are your thoughts on EA right now? Their stock has dropped about $18, But since they announced Battlefield 2042 will be delayed until November. On the day of the announcement, an insider sold 1,000 shares, but hasn't sold since, potentially indicating that he thinks the stock is undervalued. I tried giving a look at the ratios, but they're all outliers. I also looked at their financial statements and saw some fluctuations manually, but I don't really understand why. I know it's too early to tell, but do you think EA could recover from this soon? It went down due to their recent announcement being delayed. I think for now it is a temporary problem, but I think the game releases in a bad state, then the backlash would cause the stock to drop even more. I don't think it is likely, but it is a possibility. Now, the quarterly earnings fluctuates due to seasonality, the launch of games, E3, which is mainly in summer actually. They do expect holiday season to be performing well. Now, my concern is that right now, Activision and Blizzard, Take-Two, and also EA represents an industry decline. We'll talk about that in a bit. Observe them to stop dropping first before investing. Now, another concern would be investors think that the post-pandemic growth for gaming will be slower, which I don't think is necessarily true, but I do see where they're coming from, which is why the stocks are going down. Okay, here we are. This is the chart for EA. Now, before that, let me just jump to the summary analysis here. And we actually covered Take-Two. Let me just go back up here. We covered Take-Two in July. We covered Activision in August. And right now we're covering EA. If you want to look at the analysis for these two, just go to the dates here for the coaching calls, and then you can look at them. So for comparison purposes, I've actually put it here so they can see clearly between the three companies how they're doing. They're all gaming companies, and they have a strong trend. And their bottom I would consider to be early for now. So for EA, right now the reason for dropping is delay of Battlefield 2024. You said it's November, right? But from the articles I found, it seems to be October. But yeah, for Take-Two, they are also delaying their GTA, I think it's GTA Online as well. There's also a tech sell-off. And for Activision and Blizzard, they have a sexual harassment lawsuit with the Blizzard's president and a few senior designers as well. So that's why I've put this down as medium risk. Without a president and a couple of the key designers, then I think Diablo 4 and a lot of other games will experience either a delay or a setback. That's why I think Activision and Blizzard is higher risk. First, let's look at the technical analysis for these three stocks. We can see after they recovered from this 2019 low about loot boxes, they have been at a high price. Take-Two, the trend I think is actually stronger than EA. And for Activision, the trend is also stronger than EA as well. And what I'm looking at here is really this part. So here you can see for EA, since July, they actually flattened out, but they're actually unable to break through this 150. Whereas Take-Two, from July onwards, they still have this rally, and then it came down. And Activision Blizzard, they have a rally as well. I think from a trend perspective, I do think these two companies are better than EA. Now, for Activision and Blizzard, I do think they have more of an issue because they have the sexual harassment lawsuits. And right now, the Bollinger Band is expanding for Take-Two, Activision Blizzard, and EA as well. I think if you're asking me, this looks like an industry-wide correction. I don't think you need to be in a rush to get in. If you do really want to get in because you think you might miss the boat, then just try to enter 1/3 of the position you want to buy. Then you lock in a small position first. But in my opinion, I think you should wait until you start to see that these other two companies is forming a bottom. For Take-Two, they probably will form a bottom near the blue EMA. Within the next 4 to 8 weeks, you can probably see it coming out of this blue EMA area or the Bollinger Band area. At that point, you will see the Bollinger Band is flattening. For Activision and Blizzard, it might do the same thing as well, but because they have the whole change in president, I think this issue is a little bit too complicated, so you probably do not want to be investing in Activision and Blizzard. So the next one is EA. If you see a similar formation near the blue EMA, then you can consider it as well. Of course, there is a slight chance it might form a V-shaped bottom, but then I wouldn't bet on that given the other two companies are also dropping as well. When you're looking at insider, here you can see there's a lot of insider sell before the drop. After the drop, you ask, well, why is there no more insider sell? Sometimes it might just be because the insider hasn't updated their transactions yet. That's why you don't see insider sell at the moment. If you just look at this chart and if you scroll down, then you can see there's actually a mix of grants and also insider sell. So you would just treat this as a mix in this case, or leaning towards insider sell. So that makes sense because when you're looking at the price action here, The reason why the stock is not going up is because there is a lot of insider selling. Hedge funds or whatnot wouldn't be buying into this stock at the moment at this high price. Now, when you're looking at EA, historically, they do have a good level of growth, given that they're a relatively big company, from 7 to 10%, including this slight dip here. If you just lower that, it's maybe 5% per year. And for 2021, there's growth as well. For this number, this actually seems a little bit lower than I imagined, because I think that they benefit a lot from the COVID boom where people just stay at home and play games. Here, then you see net income. It fluctuates quite a bit. There's actually a little bit of noise in here. We look at why that is the case. It's mainly because this year they have a tax rebate of $1.5 billion. If you take this out, then that actually lowers it to around 1 to 1.5 billion of net income per year. In terms of whether they have any unusual expense, it's mainly because they spent a lot more money on marketing here and also R&D. That led to an increase in costs, which decreased their profitability. I would say on average, they're making around about $1 billion a year. This might be off by 200 mil, 300 mils. The difference you're looking at is really around here, where they increased the SG&A expense by 300 mil and R&D here by 200 mil. So that's 500 mil you're looking for. If they're spending money on marketing and also research and development, that's actually fine, because as long as they produce good games, then eventually they will recoup that cost. When you're looking at the quarterly financial statements, you see there is seasonality that is in place. For example, December is a relatively good quarter for them because, of course, Christmas. And afterwards, you also see June. This is probably due to E3 as well. What you want to compare is really the June to June quarter here, which you see there is an overall growth. Now, if you scroll down below, then here you will see the profitability actually declined slightly in terms of net income, from 365 down to 204. If you're looking for the reason, it's because they have higher SG&A expense and R&D. Basically, they're putting more money into marketing and research. Right now, their revenue is not increasing as quickly yet. So it might eventually pay off near the Christmas season. That depends on your understanding of the company and the games that are coming out. Yeah, if you do a bit more research on Battlefield 2024 and you think it's okay, then it might get paid off during that time. Now, when you're looking at cash and you're trying to understand why the cash here is declining, this is mainly due to acquisitions EA has made. Here you can see the cash has been declining for the last 2 quarters. If you jump over to cash flow here and you click quarterly and you scroll down, you will see there are 2 major transactions that are called net assets from acquisitions. That's what used up their cash, which I think is fine. It's just EA's way of expanding. If you scroll down here, then you can take this 5 billion divided by 7.7. The debt to equity ratio is actually less than 1 to 1. I put down good here. The article I found, just a week or 2 ago, they said it is delayed till October, but not November. The date you found might be more recent, but I think either way, that's okay, because we understand what the issue is. Before we continue our analysis with EA, I just want to take a minute to kind of compare the income statements between EA, Take-Two, and Activision and Blizzard. It gives you a feel on why I think the annual growth number was low in the most recent year. Here you can see for Activision and Blizzard, the growth is around 6% per year other than 2019. And for 2020, it was actually 25%. This number makes sense to me because of COVID. Now for Take-Two, in 2019, I think they have an acquisition, which is why there's a jump in terms of revenue. And then since then, they're growing at 9% as well. In that case, which explains their trend, I think that's fine. I need to double check if this is an acquisition or is actually a game release. When you're looking at EA here, you can see the growth is actually similar. For COVID, I'm actually surprised the growth is not as strong as I thought. I would say between the growth of all 3 companies, EA is on the slightly slower. Let me just go down here. If you're looking at for efficiency, for example, Take-Two is making around $3 billion and net income is around 400 million. Let's take a more conservative 500 million, right? And for EA here, they're making around $6 billion and their net income is around $1 billion. We want to exclude this tax rebate. Let me just quickly calculate what that ratio is. 1 divided by 5.5, that is 18%. So that means for every dollar they earn, they get to keep 18 cents of it. And for Take-Two, 3.4, it's 18% or 17.6% as well. So it's actually fairly similar. And if you look at Activision and Blizzard, they are growing at a similar place. Here is 8 billion revenue and 2.2. So 27. So let's see if there's an outlier here. So this number seems relatively high, 6.45. So 23. So I guess for Activision, their margin is higher than the other two. And I think it is mainly because of World of Warcraft. But yeah, so between the three companies, Activision is actually more profitable in the sense where you can see the revenue figure. It is bigger than the other two. And also the profitability, which is the money they get to keep, it's also higher than the other two as well. So let me just quickly take a look at the quarterly financials to see if there's any additional insights I can offer you. So for quarterly, for the last 2 quarters, Activision is not growing that much. And for Take-Two, they're actually having a slight decline as well after December. And same for EA. So chances are we do need to compare the year-over-year quarter instead. So in this case, the only one that grew is actually Activision and Blizzard. Yeah, I think between the three, Activision probably has the strongest in terms of financials, but I don't think the issue of the sexual harassment and the change in Blizzard president is over yet. You probably need to be more patient if you're waiting for Activision. But other than that, I think between Take-Two and EA, they're pretty similar. It's just a matter of what kind of games they're going to be releasing soon. Whereas Take-Two is, you will get a better discount because right now it's between the red and the blue area. For EA, you're getting less of a discount. And I think it's mainly because for the last 2 quarters, Take-Two has a slight decline, where if you compare this number, there's actually a decline versus EA, there's a slight increase. Okay. For dividend for EA is 0.54%, was pretty low. You can use options. And for earnings, they are expecting really good earnings in 2 quarters. Basically Christmas, which should be coming out near January, February. So if you're looking at EA here, then watch for the next couple of weeks because you still haven't gotten to Q3 earnings yet to see if it forms a bottom. If it forms a bottom around this area, then you can enter once it is more mature. For Activision and Blizzard, they are expecting a Christmas sales bump as well. For Take-Two, there isn't as much of a bump in terms of Christmas sales. They're actually expecting to do a lot better in mid next year. Looking at that, probably what you want to do is if you want to invest in near term, then probably EA or Activision, if for some odd reason you're comfortable with the sexual harassment lawsuits. In closer to the summertime, then Take-Two will be a better choice. So it depends on when you observe the bottom and how mature it is. So if you are then investing in EA, try to use January 2024 option after a couple of weeks. And chances are you want to use a strike price that is the blue EMA or below. So watch for where the bottom is forming and then use a strike price that's below the bottom. Chances are you want to use a strike price that's below this point, this pin, and it's going to be below 108. So just see how much of a discount you can get for EA. So the next stock is Felix. Amazon Care versus TDoc. TDoc is making a statement where they're not afraid of Amazon, but I think we should expect Amazon to take up significant market share in the future as well. Given the industry itself is growing quickly, TDoc should continue to grow for years to come. So the question submitted by Felix was really, should we be concerned about Amazon going into the healthcare market? So here's the article from Motley Fool, where Amazon is actually heading into the virtual healthcare market as well. So Teladoc is saying that they're not worried about it. And I think right now Amazon is starting, so they are playing the catch-up game. But I think when you're looking at this market, there can be multiple players, like 2 to 3 large players as the end game. So I don't think necessarily it is a bad thing. And when you're looking at the market, the CAGR, which is the compound annual growth, is 24%. So even if going forward, Amazon and Teladoc is taking up the share 50-50, they should still be able to grow at 24% per year. So I think in terms of the growth hypothesis is there because the market is expanding. And right now we're in a post-COVID world, so that's why Teladoc is down. So what you're really waiting for is really some kind of uptick before the earnings, so then you would invest in it. So here you can see a bottom is actually forming, the Bollinger Band is starting to flatten, and in the recent week or two, it is starting to expand a little bit. So what you're looking for is really an upward candle, an up white candle that will give you an indication that the bottom is complete. So we have been observing this for a while now, but so far we haven't seen it yet. But basically what we're looking for is a candle like this, similar to what we're seeing in Suncor here. Or let's see if we see one for Kirkland. This one's harder to see because I have all these lines. So these type of candles where it signals to you that the bottom is over. So I think if you're looking to invest in TDOC, I think the company itself is growing very rapidly, and they recently completed their acquisition as well. So I think there is a very strong reason to invest in it. There is insider sell, so I would say just wait until you see a candle which signals a change in trend from this currently correction once the bottom matures. Okay, so the next question is how to think about hedging. So right now, there are 3 hedging positions I have. So the first one is Suncor, and I have it for December 17th, 2021. So as of this moment, my call position actually already fully covers the put position that I have. So I'm not too worried about it, and chances are I'll hold on to this put position until it expires in December. And the reason is because the Bollinger Band is still expanding, and it is very likely that Suncor will form a W if it encounters some resistance here at the red EMA. So at that point, I want to have the put position as a layer of protection. So ideally, if Suncor continues to go up because the gas shortage worsened, then I think the put option will expire worthless, which is the best case scenario. The next one I have is AC. For Air Canada, the Bollinger Band was expanding a little bit as well, so that's why I have a position until November 19th. And chances are I'm going to be holding this until expiry as well. And the reason is because Air Canada's earnings is being released the first week of November. It's like November 2nd or November 3rd. So that's why I want the protection until earnings is out. So if it goes up to here and it shoots higher because they're releasing better earnings because people are traveling in the last couple of months, then I think that's great. So ideally, we want the put option to expire worthless. The next one is Kirkland Gold. So here you can see that for gold prices, we previously expect that it would go up to this 1900 level, but it didn't. So right now it's kind of hovering and getting closer to this 1700 level again. Now, surprisingly, even though it is coming down to this red EMA, Kirkland Gold is actually going up. And I think the combination is really that Kirkland Gold has been performing well as a company, and also there's insider buy as well. So that's why the stock price is going up, because historically, the trend for Kirkland Gold is quite strong anyways. So here at this point, I bought a put position just to protect in case there is a drop in gold prices, which lead to any temporary decrease. But I expect that given the insider buy, the company redemption of the shares, this should push Kirkland Gold higher. So at this point. So ideally, I do want the put positions to expire worthless as well. So the last stock pick is Disney. And they say there are COVID production delays, which lead to lower subscriber growth for Disney Plus. So as we step into the post-COVID world, I actually think the growth for Disney wouldn't be driven by Disney Plus. Instead, it will be driven by Disney theme parks and movies, which are going to be released in the next year or Christmas, like Spider-Man, Doctor Strange, and Ant-Man and more. So next year will be a year of growth for Disney. So the window of opportunity between today and Q3 earnings release is getting smaller. So we'll need to watch very carefully whether there is an opportunity. So it's around, 47 days? Okay. So let's look at the chart for Disney. So earlier the week, Disney was actually touching the lower BB band, but then on Friday, it rebounded back up to here. So we'll have to see if we get a deeper discount with Disney. So if Disney goes back down to this red EMA level, then I do think it is quite a good buy. if it is hovering within this range, then I would say is an okay price. It's not at a very deep discount, but if you want to use shares at this price, then it's probably okay. But chances are you want to be waiting for a discount, which is closer to the red EMA or lower. Now, when you're looking at this article, they're basically saying that there is a production delay, which will lower the number of streaming clients. And I think really, as we step out of COVID, there's going to be less subscribers for Disney Plus, which kind of makes sense to me. But on the flip side, the theme parks and all the other stuff will be reopening, which should benefit Disney. So here you can see there are some grants, and there are also some sales as well. So here I put down mixed with grants. So for Disney, they generally grow around 8 to 10% per year, other than the year of COVID where movies and theme parks are closed. So they actually made a loss here, and previously they're making around $10 billion. And if you scroll down to quarterly, then here you can see their growth. I wouldn't say it has slowed down as well, because you can see June here, the year-over-year growth is still 9%. And I think near December, as more movies are being released, that should benefit them as well. And if you go here, then I think you can see they're restoring profitability, which is fine. Now, when you're looking at a quarterly basis, they do have a lot of cash, so I'm not too worried about that. And if you scroll down, then it's 1-to-1 debt to equity ratio, which I think it's okay. So far, they actually stopped their dividends since 2019. And when you're looking at the earnings for Disney going forward, they're actually expecting a very good fourth quarter, first quarter, and a second quarter as well. So that's why I said the window of opportunity is really between today to Q3 earnings being released. So it's actually Q4 earnings being released. That's where you get the uptick. So hopefully the window of opportunity is that you'll get a discount down here, close to the red EMA, between now to Q4, and then afterwards it will continue to go up. So that's kind of what you would expect. And if you're looking at this earnings website, let me just take a quick look here. They are expecting earnings, revenue to be going up in this case for the next quarter. And for earnings, they're expecting to be flat next quarter. And then for the next 3 quarters, it will be at a higher level because the economy is reopening, people are traveling, so on and so forth. And finally, there are options. So at this price, I don't think you really need to use options because the risk is higher. So once it is closer to the red EMA and you see the price is stabilized and forming a bottom, then you want to use a blue EMA as your strike price. And you will need to observe how far it is dropping to know that. So we'll circle back to this and we'll just keep watching it for now. So that's pretty much it for this week. And let me know if you have any questions. Welcome back to February 11th, 2022 weekly coaching call for Investing Accelerator. So for this week, we have a relatively shorter week where we are going to first talk about what I think about interest rate increase and how that impacts the market for each of the major sectors. And then afterwards, we're going to talk about quick update, the tension between US and Ukraine and Russia. So that is currently spiking oil and gold prices. Actually, we'll be talking about this first. And then afterwards, in terms of quick updates, we'll be including Netflix as well for entry. And then in terms of stock picks today, we only have APPN from Rob and also Etsy from Rob. So previously I was thinking whether we want to cover Etsy, but then we will be covering that as well. All right, so let's start from the beginning. So if you have been wondering on Friday, why is the market suddenly down except for oil and gold? And that is because US is saying that Russia will be attacking Ukraine next week. So currently there's going to be a talk between Biden and Putin tomorrow, and then we'll see how that goes. So I expect this is actually spiking up oil price. So US oil to over 90 now. So right now it's 93. So it is actually quite possible to hit 100 given the uncertainty of the situation. So I suspect for the next couple of weeks, the oil price will continue to go up. For gold prices, it is also spiking up. So right now it's at 1858. So gold prices has been in this consolidation period for a long time. So we'll just have to observe if this level of uncertainty is enough to push it over 1900 or even potentially touching 2000. So if you have gold stocks and you're planning for an exit, then I think in the next couple of months, if it does spike up to that kind of level, like 1900 to 2000, then your gold price stocks will be going up as well. So make sure you plan for an exit during that time. Okay, so that is that. So let's talk about the market before we do individual stock updates. So Steve, interest rate increase. Could you let us know your thoughts about how we should plan for the Fed rate hike that will happen in March and other interest rate hike this year? The market has been very volatile and highly unexpected inflation really hurts the markets. Thank you. So when Fed is talking about interest rate increase, there's really market fear. So that's why the stocks are going down, but it is just a fear, but not what's actually happening in the markets in terms of fundamentals. So the fundamentals of those companies have not changed yet, but it is reacting to it based on the news alone. So for interest rate increase, technology sector declined due to fear of unprofitable business going bankrupt, and housing sector declined due to fear of defaulting on their mortgage payments. So some people who are a little bit tight on cash can potentially default and not being able to pay for the additional payments. So that is really the concern. So technology companies' reality. So profitable technology companies will prevail. So that's why you need to look at fundamental analysis. Companies with huge cash balance will prevail. So a lot of companies during the boom, they have already raised capital. So then they have a lot of cash on hand. So then they will be able to weather through the storm. So those ones are good ones. However, the fear will still drive down stock prices. So right now we observe some technology companies are giving back all of their COVID gains, including Facebook, Netflix, PayPal, Square, TDoc, and also medical companies such as Moderna, COVID-driven stocks such as Peloton as well, Peloton. So when you think about what's happening here, for example, Facebook, Netflix, PayPal, Square, these have very strong financials, so they're going to be fine. Whereas for TDoc, Moderna, there is also another trend where we're stepping out of COVID. That is slightly against them, which is why it is dropping. So I can just show you quickly. So we'll be talking about Netflix later today. But here you can see that is the sharpness of the drop. So what you're really waiting for is a more solid bottom. And for Moderna, the second issue here is really the overall economy is stepping out of the pandemic. So right now we're really heading towards a post-COVID world. So then you should focus on post-COVID stocks, which I'll go through in a bit. Housing reality. People who have fixed rate mortgage will probably be fine for the next couple of years. People who have variable mortgages will be fine right now as the payments are fixed. So that really depends on how the mortgage is structured. So for example, for my mortgage, if the interest rate increase, it actually does not change the payment itself. What it changes is the amount of interest I'm paying on a monthly basis versus the amount of principal that is being paid down. So then by having an interest rate increase, for now, there's actually no impact to my mortgage. But in 3 to 5 years, when it gets renewed, then that's when you will see the remaining payments plus the increase in interest rates. So this means the real problem will be refinancing, which may happen 3 to 5 years from now. So for the next 3 to 5 years, it will still be a bull market overall, mainly because of housing shortage, supply chain shortage or whatnot. And we see that housing companies already reflected the fear in the interest rate increase and have gone down. So here is Redfin, Open, and Zillow. So these are actually the technology housing companies, which means they're getting hit especially hard. So here you can see, first there is the boom for Zillow. Now there is also the iBuying program problem that is kind of built into this. So then now you can see Zillow is forming a W here. And then Redfin, another housing website. Now you can also look at construction companies as well. Then you don't have the technology impact that is kind of influencing all of them together. And finally, Open. So here you can see right now it's at a very cheap price. So these have already crashed in anticipation of the interest rate increase. So they are relatively cheap. So it's a matter of kind of the housing shortage kicking in, so on and so forth. So you can also look at renovation stock, kind of like interior design. I think we covered a couple of those earlier, and any construction related companies as well. Commodity. Theoretically speaking, the increase in interest rates will lead to a decline in commodity prices. However, we also have a supply chain shortage and interest rate has not actually increased yet. So for example, technically, if interest rate increase, gold prices should be going down because people will be more inclined to invest in bonds instead of gold. So that is the concept here. But then if there's also a war between Ukraine and Russia, then that kind of fear will keep the gold prices high. So that's how you should think about the situation. So that's why right now a lot of basic commodities such as iron or copper are still at all-time high because of that supply chain shortage. And I do expect commodity prices to calm down in the near future, but it's heavily dependent on the supply chain crisis, which is China instead of interest rates. So given that China is still battling COVID, they're still closing its borders, I don't think commodity prices will be going back down anytime soon. So late stage interest rate increase. So what I've covered here is really the fear of interest rate increase. So right now, Feds has not increased the interest rate yet. So we're still in kind of the rumor stage. So people are still talking about it, how much it is going to be, how often it is going to be. So there's a lot of fear built into this situation. Now, once interest rate has increased a couple of times, so I'm talking about after June. So this is like 2 or 3 times increase, like September or December timeframe, then people will realize that, hey, interest rate increase is okay. We don't need to panic and start investing again. So we shouldn't encounter any problems until the default rates for properties increase or companies start going bankrupt. So if the interest rate increase and people are able to live with that, meaning that's increasing by 0.25% or 0.5%, does not crash the market, then that will restore people's confidence. Hence, the market will be going up. So I expect that, for the March increase, there's going to be a slight drop, and then the drop will be reducing over time as people gain more confidence. Now, for oil and gas, it heavily depends on oil and gas price shortage, and winter is probably coming to an end. So the only thing that is keeping oil and gas high is really Ukraine and the Russia conflict. So you'll have to see how that goes. And once this issue gets resolved, then the oil and gas price will probably come down. So I would say the oil and gas run is pretty much 80 to 90% done. Now, you might be interested in, when was the last time Feds increased their interest rates? And you want to look at this and compare to S&P 500. So if you look at this chart, then you will see there was an increase back from 2005 onwards, and also 2016 onwards as well. So if you go back here and go to SPY, and you zoom out, and you look at 2015-16, look, even if the interest rate increase, it continues to be a bull market for 4 or 5 years until you hit COVID, of course. And it's a relatively short crash. Anyways, so the next one is really 2005. So 2005, this is where you still get a bull market for a couple of years until you get mortgage fraud. Then that's when you get the 2008 financial crisis here. So you need to think carefully that, hey, perhaps it's going to be fine for a couple of years until the mortgage fraud kicks in. And every single crash is not going to be the same. So even if there is a mortgage crisis back in 2008, it doesn't mean it will be repeated because banks will be smarter. So then that delays the crash further. So they probably have better controls to prevent that from happening. Okay, so just because interest rate increased by 0.25%, it doesn't mean the market will go down immediately. It will probably take some time for the effect to kick in. So that's the point. All right, so going forward. What you should focus on. So airlines, travel. So as North America are abandoning COVID measures, some states are not requiring masks anymore, no more COVID restriction. We're seeing airlines to start going up as well. So I expect this summer, airlines and airline stocks will be quite popular. So meaning people will be flying and the stock itself. So DAL, UAL, ACBA. I also expect travel stocks to be quite popular as well, like Expedia, Hotel, Airbnb. So I looked at hotel stocks and it is really not at a discount at the moment. So I think airlines are still at a discount. So let me just show you, for example, UAL, you can see it's still within range. I think once they post more financial results, then it will break through this red and blue EMA. So DAL, same concept here. AC, this one. So AC here, you can see it just touched the upper Bollinger Band. So it's just waiting for the breakout and Boeing. So right now, a lot of these airline related stocks haven't broke through because I think on the global scale, there's still restriction when it comes to flight. Now, when you're looking at hotels, for example, like Marriott, it has already recovered significantly because there is domestic travel. So I think that is good. For example, Hyatt, you can see it is not really at a discount. Hilton, I think Hilton is HLT. So you can see these stocks are not at a discount at the moment because the market already reflected that from the domestic travel side. And I think the only one that is probably at an okay price is Airbnb at the moment. So you can see right now the price is actually fluctuating between 140 to 200. So looking at the growth, it should be having an uptrend in the future. Looking at the fundamentals, it should be having an uptrend in the future. But for now, it's just kind of fluctuating in the middle. So I think if you are using stocks, long-term hold at Airbnb, it should be okay. If you're expecting to hold till, global travel fully recovered. Okay, so I think a breakout will be happening for stocks such as Airbnb later this year, probably after June. The next one is entertainment. So as people start to travel, I think traditional retail entertainment will gain traction again. For example, Disney is reporting good earnings after the parks are full and more movies are coming out. So that is really the end of this webinar. And thank you very much for attending all the way till the end. And I know you're the top 1% people that attended this webinar till the end, and you are very passionate about investing. And I know you need help so then you can take investing to the next level. So for that reason, please book a strategy session with me so then we can have an in-depth discussion about your current situation and how I can help you. There are limited spots available to schedule a call with me, so then you need to act now and complete the application form so that I can review your situation and then we can have a chat for 45 minutes in the next couple of days. So thank you again for your time, and I look forward to chat with you on the call.